12:11 now. You're listening to WGN. This is the Wintrust Business Lunch. We have conversations like this every day from noon to 1, often with Craig Bolanos, the co-founder and wealth advisor at VestGen Wealth Partners. The website is getretiredstayretired.com. Craig, welcome back to the show.
John, great to be with you. What a week. Roller coasters, lots to talk about. Trump, tariffs, NVIDIA, you name it, but the direction remains correct. As goes January, so goes the year.
So how's January going?
Well, I think January's going good. If you have a 401k, if you have a workplace retirement plan, an IRA, and you have an allocation to stocks in the United States, you saw a market where the S&P 400, large caps, mid caps, small caps, all rallied, and the best news of all is 10 of the 11 sectors in the S&P so far are positive for the month. That means this market rally is broadening. I'm hoping to see more evidence of that in the weeks to come.
You're not worried about NVIDIA and DeepSeek and what all of that means?
Of course I'm worried about DeepSeek, because anytime something comes out like this, do you know what the implications are? It challenges this notion of U.S. exceptionalism in the artificial intelligence space. But clearly, based on market reactions, people are going to continue to parse DeepSeek's cost. Did they really spend $6 million? Is their performance data real? Did they actually just use the large language models of OpenAI? I don't think it's a game changer yet, but it puts everyone on notice that America needs to stay in the forefront in the race to AI, and clearly there's challenges from abroad.
There's talk that all this money invested in NVIDIA and those very expensive chips and the very expensive servers and cooling stations that house them is money that did not have to be spent, or at least there's a less expensive way to do all of this. And if that's the case, it makes you wonder about all of the money that's been thrown at these things.
It definitely calls to question. I do not deny that at all. I mean, using NVIDIA just as an example, I mean, there's a stock that was trading in the 70s not that long ago. We're talking about the early part of last year. Now it's $125 a share coming across my tape. But the truth is the AI cycle is so substantive, so changing, and oftentimes the early leaders, they tend to set the pace and set the lead. So I think this is definitely noticeable, puts companies on notice that maybe we need to be more careful about how we spend and the cost to adopt, but it doesn't change or derail that artificial intelligence is being adopted throughout all industries to increase productivity, which hopefully should increase profits, which leads to better earnings per share that can continue to move markets higher.
We're talking to wealth advisor Craig Bolanos at VestGen Wealth Partners. Then what about the strength of the rest of the market?
Well, I'm encouraged by what I saw with mid caps so far this year, small caps, et cetera. And very specifically, I was happy that in the month of January, you saw progress made in financials, in healthcare, in some of the sectors that largely didn't participate. You know, the story has been about the Magnificent Seven, the Elite Eight, the FANG stocks, whatever acronym you want to choose to include. But if we can be on a place where we start seeing money and fund flow go into these other areas that performed well in January, I think that bodes well for an economy that looks like it's heading to a soft landing and allows markets to have a firmer base, and that should give people confidence to save and invest for their future retirement.
Well, then what do you make of Warren Buffett keeping all of that cash on the side?
You know, I think Warren Buffett has always done something and done something well, which is he has said to people, hey, you should have low-cost, tax-efficient investments for a portion of your portfolio. He's advocated for indexing. But in addition to that, his job at the company, Berkshire Hathaway, is to be active. And if you want to be active and you want to be opportunistic, sometimes you need to be what I call a contrarian investor. You need to go ahead and sell into strength, sit on cash and wait for better opportunities. And while I'm positive and constructive on 2025, I do think 2025 is going to be the year that volatility and VIX returns. We're overdue for those 5% dips. We're overdue for those 10 to 15% corrections. So I think a lot of us could realize that just as Warren Buffett rebalances, we should too.
So all of that optimism you're expressing flies a little in the face of what you just said. I'm not saying you're contradicting yourself, but that's a more cautionary note than you said so far. Let's pause right here for a second, Craig. I want to update our listeners on the markets, and we'll come back into the WGN Radio Newsroom with Bobcast.com. We're talking to Craig Bolanos here on the Wintrust Business Lunch. He's the co-founder and wealth advisor at VestGen Wealth Partners. What are you thinking about the Fed right now? Either your forecast or what they say, or what they've been saying lately, Craig?
Well, John, I think no one was surprised that after getting not one, not two, but three different policy decisions at the end of last year, that we were going to take a pause in January. And I think the pause is incredibly responsible. You and I talked just 2 weeks ago that I think the first chance in 2025 for rate cuts is the July or the September meeting. Nothing's going to happen before then because we need to see what type of fiscal programs are going to be coming out of Congress.
Canada is our number one trading partner. It's not clear what's going to happen today. What do you think would happen, though, if we imposed a 25% tariff on Canada?
It would be bad. And I really hope it wouldn't apply to energy prices because we do get a lot of oil coming out of Canada. So anything that is a tariff ultimately is a tax on the consumer. And between President Trump and his Treasury Secretary, the Treasury Secretary says 2.5% across the board. President Trump says 25. I hope someone's got the decimal point in the wrong place.
Yeah, no kidding. Speaking of decimal points, inflation has been described to me as stubborn, but is also fairly close to the target. What do you think about the inflation rate right now?
I think we're getting there. It is stubborn, it is persistent, it is sticky, but as our Chicago Fed president just said today, Austin Goolsbee, he said, hey, I'm not going to make too much of any 1 month. That was his quote. But he also said, quote, I have comfort. I won't say overconfidence, but he says he has comfort that we're on the path. And I think he's right. We're seeing a slowdown in the year-over-year change in shelter. That's been the biggest component of keeping these inflationary data higher. And if that breaks, we're not getting to 2% by the end of 2025. But I certainly don't think we're going back to 3.5% and 4%. And that's welcome news for all investors and borrowers.
What do you think the Fed's going to do with rates this year? Are they going to give us 1, 2, 3 more cuts?
I think at best we get 2 cuts, but I think we'll get at least 1 additional rate cut in that July, more likely the September meeting. I think that's what people have to look forward to between now and then. It's just policy noise. All eyes are on Washington, D.C., and eyes are on corporate earnings and this economy where they should be. And yes, by the way, John, the economy, jobless claims, non-defense spending, retail sales, non-farm payrolls, services, it all looks good still.
Speaking of interest rates, though, Terry Savage and I visited with a guest on Wednesday who was much more the contrarian than you are. And among other things, he pointed to mortgages and people who just won't give up 3% mortgages. He really sees the housing industry as a weight on the economy, and he's fairly bearish about 2025. Just talk about that and the real estate sector in general.
I think the real estate sector is a little bit stuck. I mean, number one, we don't have enough housing for everybody, and we haven't had enough new home starts and new constructions. Obviously, the interest rates don't help, but I've said it on your show. I'll say it again, John. I think there's a large part of America who's committed to bunk beds because they're not going to part with their 3% mortgage. They're not going to upgrade from the 2 or 3 bedroom house to the 4 bedroom. They're just going to bunk bed the kids like we did in the 70s when mortgage rates were obscenely high. Today, they're high relative to where we were, but you're right. When people aren't switching houses, there's not a lot of consumerism that's happening around what people spend when they move, and that is a drag on the economy.
Speaking of consumerism, so eggs are expensive, and that probably is less due to economies as it is to the bird flu. I mean, it seems almost certainly that's what eggs are all about. Can you just talk about individual items in the grocery cart and what's expensive and what's relatively inexpensive right now?
Well, I'm going to tell you, the first thing that's expensive is on the other side of the pond in the UK. We call them crisps. I call them chips. My 99-cent bag of my favorite goodies, they're all $2.49 to $2.99, and there's 5 less chips. That's not going to change. What am I worried about right now? If these tariffs did come in from across the border, we put them on Mexico. I mean, I love a good cold beer, and I don't know people appreciate how much beer comes from Mexico. And think about this, there's nothing better than chips and guac. The price of avocados could skyrocket. So what am I focused on? I'm focused on the fact that we're all being asked to pay more, but I'm very focused as an investor on the fact that wages are growing now to help outpace the year-over-year change. Can't do anything about the damage that's occurred, but if we can continue to see wage growth, I think the American consumer will have brighter days ahead.
They don't say that, the American consumer. They don't call in and say, hey, John, food is expensive, but thank God I'm making more than I used to. Wages are increasing at a rate faster than the inflation rate, I understand, but it sure doesn't seem like people are feeling that.
There are, and let's be sincere, there are people that have been marginalized in this economy for so many reasons. So many reasons. There are people eating hamburger helper without the hamburger. I am very much aware of that, but I look at people's actions much more so compared to their words, and the amount of retail spending that consistently happens from various facets of the American consumer tells me that while everyone's mad and upset, people are not modifying their behavior yet.
Yeah, but you're not championing that, are you?
I'm not championing that because some of that spending is definitely being done on what I call borrowed time. I mean, no one borrows as well as the American consumer. That means our credit card balances are running very, very high, but we're not seeing any signs of delinquencies yet that would scare somebody to prevent them from investing. But I do want to be sensitive, John, to our entire listening audience that it's tough. The housing cost, the food cost on 123 Main Street, we know it's derailed some people and created hard choices.
We're talking to Craig Bolanos. Producer Pete, I'm looking at you, buddy. Do I have one more minute here to talk to our guest? Yeah, so we need to wrap this up. Last thoughts from you then, Craig. Overall, what are you thinking, seeing, feeling?
You know, you mentioned Warren Buffett earlier, and here's my comment. Warren Buffett clearly views that raising some cash in the fourth quarter of last year and continuing to do so in Q1 of 2025 makes sense. And I think that is screaming that everybody should be rebalancing their portfolios in accordance with their risk budget and their financial plan. That doesn't mean stock markets are about to be bad. It just means control your risk, because that's within each of us to do.
Nice to talk to you today, Craig. Always very interesting. Thanks for your thoughts.
Great to be with you, John. Thank you.
Craig Bolanos is the co-founder and wealth advisor at VestGen Wealth Partners. Click on getretiredstayretired.com. 1227 News.